Since Bitcoin's October peak, Bitcoin is down 49%. The asset this fund holds is up about 26% since that peak. Same storm, opposite outcomes. You have watched this exact movie over and over. Watch how each one ends. The AI server run, up 450%, then down 80. The quantum run, up 1100%, then down 58. The nuclear run, up 3000%, then down 76. The space run, up 4000%, then down 54. The silver run, up 450%, then down 52. Everyone felt unstoppable at the top. Everyone ended. And the sixth is the one we called. On June 12th, we said it plainly. Rotate out of AI. 9 days later, the leveraged AI trade topped, and it has crashed since. Down more than 50% from that peak, and 26% in the last week alone. The money a broken run releases has to go somewhere. First, why believe us? June 29th, we published this page. The framework said plainly, cooling inflation moves the Fed, and the Fed moves Bitcoin. Dated and public before the print. July 6th, we published this one. The jobs market cracking beneath a benign headline before the odds moved. 8 days later, the print landed our way, and the hike scare died in an afternoon. Now the frame for everything that follows. The AI run is over for now. Not the technology, not the build-out. The run, the easy phase where the trade only went up, ended in June. The way every run on the wall you just saw ended. The business is at records and the chart broke anyway. And holding both of those at once is exactly how you know it was the run that died. Here is 2026 scoreboard, and we are going to walk it row by row. Row 1, the year's monster. AI semiconductors, up 68% this year, and that is after a 19% cut this month. From January to the June peak, the run was 107%. Now hold both truths at once. The business is at records. Korea just printed its first $40 billion chip month. The memory is booked into 2027, and every cloud giant raised its spending. And the stocks are priced not on this quarter, which is spectacular, but on the 2029 story, where any narrative can knock them, and this month one did. So if you're sitting on that trade, hear the framing precisely. You would not be selling because something broke. You would be selling because you won. That is what taking profits means, and it is only ever available at a party. Row 2, oil, up 38% on the spot barrel. Now watch how. A war spike above 110 on the American barrel. A full round trip back to 70 when the panic faded. And a second leg on a blockade that repriced the flow of ships. Not the demand for crude. That is not a trend. That is a premium that appears when missiles fly and has already evaporated once this year. You can see all 3 chapters on the chart, the spike, the round trip, the second leg. Premiums have chapters, trends do not. You do not compound a war premium, you collect it, and the disciplined version of collecting it is called selling some. Row 3, the classic shelter. And this year it charged admission. Gold, down about 8% in the fund people actually hold. It spiked with the war, faded with the ceasefire talks, and the net for anyone who hid there this year is a small loss. None of this says gold is broken forever. It says the 2026 ledger is honest. The shelter did not shelter. And when the classic hedge is negative on the year while the thing it hedges sits near records, the hiding was the risk. Row 4, the other classic, long bonds, down 3. The market spent the spring pricing rate hikes during the oil scare, and long duration paid the bill. That scare is dead now, and we published the print that killed it. But the ledger stands. The safest looking line on the menu lost money this year, while cash quietly did better. The old reflexes have stopped paying. Row 5, quickly, silver, down 22. The metal that markets itself as gold with torque delivered the torque in the wrong direction. Same lesson, louder. So where does the money from a broken run go? It goes looking for the next one. Watch the parade. One hot trade after another went vertical, then broke. Space names ran 4,000 and 6,000% from the base, then got cut in half. Nuclear ran 3,000, then fell 70 and 80. Quantum, drones, rare earths, leveraged chips, silver. Some climbed 500%, some 1,000. some several thousand, and every single one gave most of it back. And count the endings as they light, because 5 runs before this one ended exactly this way, and the 6th is ending on your screen. Here is the discipline in one line. Not every company on this wall fails. Every run on it ended. That is what a run is, and knowing the difference is the whole game. This is not hindsight. Watch what we said and what hit. June 12th, we said AI CapEx is digesting. Rotate out of AI into Bitcoin, and today the AI trade is selling off. July 6th, we said the jobs headline was a crack. The data, 720,000 people left the labor force, participation at a multi-year low. July 14th, we said inflation had rolled over. The print, headline 3.5, core 2.6, both below expectations. And the July hike odds collapsed from 42 to 12. 3 calls, 3 confirmations, all dated, all public. We do not get to move those dates. And the last row, Bitcoin, down 26% this year. The deepest laggard on a board where everything else already ran. But the bottom row is not the loser. It is the inventory. Bitcoin is set up for its run now, and here is the reason. Measured against the one yardstick it cannot argue with. The money it competes with, the money supply. Here is the case, and it starts with the only yardstick Bitcoin cannot argue with, its own history. Priced against the money it competes with, Bitcoin took a bigger share at every cycle peak. 2.35% in 2017, 5.99% in 2021, 11.21% at the October top. Today it trades at about 5.5%, under half its own record share. And look at the floors. The bottom of this cycle sits where the top of the last one did. Now the honesty that makes this usable, and we will keep saying it, cheap is a valuation statement, not a timing promise. The money supply is a ratio here, like price to earnings, not a crystal ball, and it explains only a small part of Bitcoin's week-to-week move. We publish the entire case with its own line in the sand, at /half price. 2 independent arguments, different data pointing the same way. Now the part that makes this different from a dip, built piece by piece, each one dated. 1. The economy is slowing. We published the crack in the jobs market on July 6th, before the odds moved. 2. Inflation has rolled over. The July 14th print killed the hike scare in an afternoon. 3. The cuts are back. September is live. And the market is pricing a cycle, not a one-off. 4. The regime is changing. The Fed has turned from fighting prices to defending growth, and the rules around this asset class are maturing in writing. Slowing growth, cooling prices, easing money, a turning regime. The last time that full stack aligned, in 2020, Bitcoin printed the best year of its decade. One precedent is a pattern's opening argument, not a law, and we hold it loosely. But the stack itself is not an opinion. Every piece of it is dated, sourced, and on your screen, and it is pointed at the one major asset still priced at under half its own record. Here is the entire video in one picture. 2 seats. The crowded seat is up 68% this year and priced on the 2029 story. And while you wait for that story to resolve, it pays you nothing. The cheap seat is down 26% this year, priced at under half its own record. And while you wait for that story to resolve, the vehicle we built on it has paid cash every single week. Same weight, different pay. Everything else in this film is just the receipts for this frame. So how do you actually rotate toward the cheap asset and get paid while the thesis argues with itself? That is what this fund is. Rebel Dividends holds Hyperliquid, and Hyperliquid already turned. While Bitcoin sits 49% below its October peak, Hype went through its own winter. The valley is right there on the chart. We printed ours while it was happening, and it is already above where the story started. You are not waiting for a recovery. You are holding one. Now the part we say plainly because we mean it. This is not sell everything and buy one fund. Concentration in any single asset, including ours, is how people get hurt. We're talking about the slice of your book that chased what already ran. Take some profit where you won. Rotate that slice toward what is cheap and pays you to wait. Size it like an adult. That conversation, your numbers, your mix, is exactly what Dean is for. The run being over is a statement about the past, and we can prove it. What the stocks do next is a statement about the future, and for that we publish conditions instead of promises. The dates that test the crowded trade are printed. The chip buyers report July 22nd through the 30th, NVIDIA in late August. And if the story strengthens, we will say so. And the one number that would flip this whole read from rotation to contagion is the S&P falling with semiconductors. The day that changes, you will hear it from us first, in writing, the same way you heard everything else. We are as confident as the evidence allows, and the evidence is stacked, dated, and public, kill switch included. The scoreboard says everything ran except the cheap one. The ledger says the cheap one's vehicle paid every week through its worst winter. The run is over for now. The next run has not been announced. Between those two sentences is where disciplined money does its quiet work, and here the quiet work pays you every week. My conviction lives at the ceiling the evidence allows, and our published scenario work, with every driver and every assumption on screen, lives at /forward. I will not put a naked number in your head from a video. That is a promise about how we treat you, not a hedge. That decision is yours, size to your life. And that phone call is Dean's whole job. 505-322-7515. The receipts are live. The dates are printed. We will be here for every single one of them.